Okay, so good morning, ladies and gentlemen, and welcome. My name is Marc van den Bos. I'm a member of the executive committee of PensioPlus. PensioPlus is the umbrella association of the Belgian pension funds, as you know, and it is my pleasure and privilege to serve as the moderator of today's webinar, which we have organized in partnership with EPRA and Willis Towers Watson. Eleanor, could you move to the next slide, please? Just a quick introduction. So, as you know, PensioPlus, umbrella association of the Belgian pension funds. Our members are IORPs and organizer of sectoral pension schemes on the one hand, and dedicated service providers on the other hand. You can move to the next slide, please, Eleanor. Thank you. Today, PensioPlus represents a sector with over 2 million members and beneficiaries, employees, self-employed and civil servants, and close to 50 billion euros in assets under management, assets that are invested for the long-term security of our members' retirement. The next slide, please. Thank you. So the mission of PensioPlus is very straightforward. We represent and defend the interests of pension funds, both here in Belgium and at the European level. We support our members by providing knowledge, guidance, and training, and we aim to bring people together, offering a platform to network, to share information, and to learn from each other's experiences. And our main goal is to emphasize the importance of the second pension pillar as an essential component of an adequate retirement income. And we actively promote good governance, sound investment practices, and the prudent management of assets. Next slide, please. So the mission of a pension fund is clear: to ensure that assets are invested prudently and in the best interests of the members and beneficiaries they serve. This principle, also known as is also known as the prudent person principle. It essentially says that pension funds must act with the diligence and prudence of a careful investor, given that the assets must be invested in the sole interest of members with a proper balance between return, risk, and liquidity. It's a principle that guides every decision we make, from portfolio construction to risk management, ensuring that short-term opportunities never undermine the long-term security. And this responsibility also requires us to continually evaluate new investment opportunities to balance safety, quality, liquidity, and return. And today we turn our attention to an asset class that has been gaining momentum internationally, yet remains relatively underused in Belgium, being listed real estate. Next slide, please. On the next slide, you will see that listed real estate offers a unique blend of characteristics. On the one hand, it brings the fundamentals of the property markets, such as stable rents, tangible assets, and long-term value creation. And on the other hand, because it's traded on regulated markets, it also adds transparency, liquidity, and accessibility. That's a bit too far. Yeah, that's it. So this combination makes listed real estate worth serious consideration, not as a replacement for other asset classes, but more as a complementary building block within a diversified pension fund portfolio. As you can see, let me briefly outline some of the key advantages. A stable income stream. Many listed real estate companies are consistent dividend payers, which aligns well with the pension fund's needs for predictable cash flows. With relatively low correlation to traditional asset classes, such as equities and bonds, listed real estate can also help diversification and reduce overall risk, portfolio risk. Since rents and property values tend to rise with inflation, listed real estate can also act as a natural hedge against long-term purchasing power erosion. And finally, liquidity, unlike direct real estate investments, which are typically illiquid and difficult to trade, listed real estate can be bought and sold quickly on the market. Of course, no investment is without its challenges. And it's also important to recognize the risks associated with listed real estate. Firstly, stock market volatility, because they are listed instruments. The short-term prices can fluctuate, even if the underlying real estate remains stable. Listed real estate is also subject to interest rate sensitivity. Rising rates can negatively affect valuations. And also market sentiment can drive prices up or down, regardless of the performance of the underlying assets. And finally, one also has to bear in mind that listed real estate entails a more limited control compared to direct property investments, given that investors have less influence over the day-to-day management of these assets. So for pension funds, I think that the challenge is therefore to weigh the risks carefully against the benefits and to integrate listed real estate in a way that supports long-term asset liability management. If you go to the next slide, you will see that in Belgium, the allocation to real estate as a whole remains modest. We see a steady balance over the years between equities and bonds over 80, almost 90%, whereas that real estate remains very limited to 3%. And Belgian IORPs tend to focus strongly on traditional asset classes with a relatively little diversification into alternatives. If you go to the next slide, you will see a split between the type of pension funds in terms of their size, with pension funds of the type A being small pension funds managing less than 25 million euros. The B stands for pension funds, medium pension funds, managing between 25 and 125 million, and the C are the larger pension funds in Belgian terms, pension funds managing over 125 million. As you can see, there has been a slight decline in real estate exposure, mainly for small pension funds in 24. When we compare this to our European peers, which is on the next slide, thank you. We see that Belgium has a relatively low allocation to real estate, between 2 to 3%. By contrast, if you look to Germany or France, for example, they have a much higher allocation, between 6 to 8%, with a significant share held in direct property. And the Netherlands stands out even more, with close to 9%. Given the importance of the Dutch pension fund sector, this is also the case for the global European market. And this brings us to the purpose of today's webinar. If you could go to the next slide. Thank you. You can see that at a European level, pension funds recognize that listed real estate can offer stability, diversification, and transparency. Key is, of course, to manage the volatility and the interest rate sensitivity with a robust risk management framework. And that is why we partnered up with EPRA and Willis Towers Watson today to organize this session, with the goal being not to promote listed real estate critically, but to provide a balanced and practical insight into how it could be incorporated into pension fund portfolios. So the program you will find on the next slide, and we will subsequently examine the strategic importance of listed real estate in pension portfolios, the macroeconomic context for investing in European listed real estate, and some practical guidance on portfolio construction. Which brings me to the introduction of today's panel. Very fortunate to have three highly experienced speakers, beginning with Thomas Symons. He's a director and global head of listed real estate and portfolio manager at Willis. And Thomas will discuss the strategic role of listed real estate in institutional portfolios. Serkan Erol is a European investment outreach manager at EBRA. Excuse me, and he will provide some insights from the perspective of the European listed real estate industry. And finally, Chris Desmet, who is a consulting actuary and senior director at Willis Towers Watson, will share some practical insights into risk management and portfolio construction for pension funds. But before we begin, a few practical details. This session will last approximately 45 minutes, and we will conclude with a Q&A session. So please don't hesitate to submit your questions via the chat function. We'll try to get to your questions at the end of the presentation. If there's not enough time to address all questions, we will make sure to follow up afterwards via email. So, ladies and gentlemen, with that, it is my great pleasure to hand it over to our first speaker, which is Thomas. Thomas?
Marc, thank you very much. Good day to you all, and thank you for taking the time to join. Before I kick off and dive into the listed real estate market, it might be helpful just to provide a little introduction to Willis Towers Watson, to WTW as an organization. On the next slide, we can see just some snapshot figures of WTW. As a business, we are an investment firm that provides investment advice and investment services to clients globally. We represent almost $180 billion of assets under management from our delegated management business. And as an organization more broadly, our investments business serves institutions with north of $4 trillion of assets under advice. We have almost 1,000 investment associates globally, which covers the range of consulting services as well as specialist researchers that are asset class focused or sector focused to deliver our clients insights into all areas of their overall portfolio strategy as well as portfolio construction. So I sit in our real assets research team, and I focus on portfolios of real assets funds as well as listed real assets research. So how does WTW think about real assets? So the next slide illustrates how we consider real assets as part of clients' overall multi-asset portfolios. And our philosophy is really one of diversification. Clients that consider real assets in the broadest sense, so that includes real estate, infrastructure, as well as natural resources across unlisted and listed markets. The priority here is to access return drivers that differ from equities and bonds, to lower the volatility of those traditional asset classes, but perhaps also enhance income or other return drivers which investors are either lacking in their current portfolio or are explicitly seeking to access through real assets. We feel that these investments that are typically long-term in nature are best addressed through themes and through specialists that are skilled in accessing those themes, those unique assets, or those differentiated return opportunities. And so we're very selective in how we identify and work with our specialist partner managers to access those value generating investments for our clients. We're quite creative in how we access those, and our research team structures and partners with managers to create new products where we see a lack of current offering. But typically in real assets, our clients that are overwhelmingly but not solely pension funds are focused on cash flow and the income component of total return. And that is in real assets a key driver for performance, but it also protects against downside risk because oftentimes that long-term contractual income is less exposed to the sentiment or macroeconomic impacts that sometimes significantly impair valuations over the short term. And given our size, scale, and presence globally, we are able to negotiate effectively with managers to deliver value for money and improved alignment for our clients through the terms and fees that our clients sign up to when they implement particular investment solutions. So taken in the round, we seek in real assets to deliver better performance for our clients from targeting those sectors that matter over the long term, implemented through best-in-class managers that specialize in those areas. And within that implementation, we have unlisted primary funds, maybe secondaries or also co-investments, but many of our clients implement their real assets exposure and their real estate exposure through listed markets, which is a global opportunity set across very many sectors and provides clients with a different implementation route than private markets because they are listed equities which offer improved liquidity, more transparent governance sometimes, and also oftentimes improved or more accessible fee structures. So the next slide illustrates how WTW is sort of a stylized view of the strategy universe and how clients might access listed real assets from the most straightforward passive exposure all the way through to active, high conviction, concentrated portfolios run by active fund managers that are seeking to select a smaller number of securities where they have real conviction that those are the value accretive securities that are expected to deliver returns to investors in the in the coming time. And I say that because different managers will have a different time horizon on those future expected returns, and different investors will have a different tolerance over the time horizon for the delivery of those returns. In between, we have what we call smart beta. So that is a more intuitive way to access this global sector, and core diversified, that are typically active managers that are more benchmark aware in nature, and so they are accessing the global opportunity set, but investing through a wide and diverse portfolio relative to an index, and are taking active bets, either overweight or underweight, or perhaps also market weight, to deliver outperformance for their investors. What we have observed over time is an evolution in the listed real estate market. To date, well, if one goes back historically, the listed real estate market was dominated by the traditional asset classes, and we can move to the next slide here, Eleanor, to illustrate this change. Going back to this slide shows how the global listed real estate index has evolved over the last 10 years. And we can go back even further to have an even starker difference in the two makeups. But historically, the global listed real estate market was made up principally of the traditional asset classes like retail, like office, like industrial. But what we have seen over the last decade and longer is the emergence of specialist sectors and perhaps what might have previously been termed the alternative sectors that are now making up a significant proportion of the index, and indeed are larger than some of those traditional sectors, most notably office. The rise of healthcare REITs, of data centers, of storage REITs have really come to the fore in recent years. And that shows how the global listed real estate market can be a great entry opportunity for clients to access these new and emerging sectors in a far more dynamic way than perhaps one might be able to do on the private side, whilst always offering that liquidity option should clients need to reposition their portfolios. And that's been to the benefit of clients that might have had a solely listed real estate exposure in the past. And we will all be aware of the prevailing market sentiment in certain areas over certainly the last 5 years. We have seen headwinds to certain sectors. Before COVID, it was the rise of e-commerce that significantly was impacting the retail sector. Then through the COVID period, we saw that e-commerce trend and the rise of logistics really accelerate, alongside concerns over use of office and return to work. And these prevailing headwinds have been very challenging for a number of market participants in those traditional sectors, that has also contributed to the rise of some of these alternative sectors. What does that mean for investors and for pension funds? It means that listed real estate can offer that dynamism that is sometimes difficult to access in private investments, where an invested standing portfolio might be harder to sell, or at least harder to sell at a prevailing valuation. And best-in-class active fund managers can identify these headwinds and reposition their portfolios in a timely fashion to ensure that they can capture these growing trends and deliver that performance to their investors. I have always spoken about the global listed real estate index, and that's because from a WTW perspective, we believe that the opportunity set within listed real estate is already reasonably constrained. The listed real estate market, if one considers the developed market index, is only around 350 securities. And so we always advocate our clients invest globally, i.e. global developed, as opposed to global including emerging markets. But I say globally rather than regionally. There are some investors that will invest in European listed real estate or North American listed real estate. We feel that clients don't need to be constrained regionally in their listed real estate exposure. And so we advocate that our clients seek to access that global opportunity set where best they can, which also allows for improved dynamism and access to some of these sectors in a way that might be more challenging in a regional fashion. So what we can see in the listed real estate market is a sector that is undergoing some change, but that is cause for opportunity as well. We see that the current prevailing sentiment on listed real estate has been an overhang on valuations, irrespective of underlying operational activity. And so the managers that we speak to are enthusiastic about the future, in that they consider there to be undervalued companies and undervalued real estate made up in the listed real estate market that causes an opportunity for outsized return in the coming years. And we have begun to see a little bit of that through 2025. And the expectation is that that continues. There is always a concern and a linkage to rates and yields, as well as over the longer term, the correlation to unlisted real estate. There may be portfolios or there may be clients with portfolios of unlisted real estate, and how a listed real estate exposure might interact with an unlisted portfolio. We feel that an unlisted portfolio, or rather, sorry, we feel that a listed real estate exposure can be very complementary to an unlisted portfolio. If one assumes that a client's unlisted portfolio may oftentimes be exposed to those more traditional sectors, a listed portfolio can provide a complementary completion to those traditional exposures by having access to, as this slide indicates, some of those more alternative sectors. And over the long term, our research suggests that the correlation between listed real estate and unlisted real estate increases as time periods extend. So over the long term, an exposure to listed real estate becomes very similar to an exposure to unlisted real estate when you compare the beta to global equities of those two exposures. If we move to the next slide, Marc outlined the dividend yields that can be generated from listed real estate, and we see over the long term that there is a dividend yield advantage for global real estate securities. We should add in there that the line below that light purple line is the dividend yield for global equities. And so investors in global real estate are generating that enhanced income yield, and that is being distributed, or at least being captured, by the investments that they might have in listed real estate. And that underpins a significant proportion of the total return. However, what WTW has observed in recent times, so over the last sort of 5 years or so, is, and maybe this is as a result of this sentiment overhang and some of these headwinds to real estate, but WTW has observed that the volatility in listed real estate has been higher than in global equities, with more severe drawdowns and a higher correlation to equities. And so WTW does question some of these diversification benefits through all time periods, given some of this elevated recent cycle volatility. Now, there are reasons to be optimistic, as I highlighted before, insofar as we are operating in a different market environment today than we have been over the last 5, 10, 15 years, with positive real rates. And so some of the value of the inflation capture that listed real estate can provide may begin to come through and drive returns. But certainly we have, as a firm, tempered our enthusiasm on the diversification benefits for global listed real estate. Certainly from a backward-looking perspective, the experience has been different to what we might have assumed. But on a go-forward basis, it is unclear whether that is to be continued or whether there are reasons to be optimistic. And Serkan will certainly bring to light some of those optimistic forward-looking prospects. And so that is the reason why we as a house consider both listed and unlisted, because through an unlisted exposure, one has a little bit more control over where to invest from a sector perspective. And some of the sectors that we have preferred as WTW as a house on the unlisted side through sector and regional specialists have delivered longer term outperformance for our clients and a more a less volatile, more stable total return experience than what has been evidenced on the listed market. So, irrespective of preferences for listed real estate or for unlisted real estate, Chris and I would love to have the opportunity to talk further about how real assets can form a part of a multi-asset portfolio. Real assets continues to be a structural part of WTW client portfolios, and the portfolio construction challenge becomes on how to manage those exposures through time, given the different headwinds, tailwinds, and sectoral evolutions that take place over time. And with that, I will stop there and pass to Serkan. Thank you for your time.
Thank you, Thomas. That was very insightful perspective on the role of global listed real estate from Willis Towers Watson's side. So what I would like to do now is to provide some additional context, looking at the outlook for where the market stands today, what past cycles can tell us about the opportunities ahead, and how investors are putting listed real estate to use in practice. Next slide, please. Let me start with a quick introduction to EPRA. So many of you will know EPRA through the FTSE EPRA Nareit indices, which we run with FTSE Russell, but our scope is actually broader. Our mission is to promote and represent the European listed real estate sectors across 5 areas: research and indexes, investor outreach, reporting and accounting, public affairs, and events and communications. We're a Brussels-based association, so we have 281 members at present, representing over 880 billion euros of real estate assets. The membership comprises of 2/3 property companies and 1/3 are investors, academics, and consultants. We create platforms for dialogue, so we have an annual flagship conference that this year takes place in Stockholm between September 16th and 18th. It plans to gather more than 400 participants, and there'll be 36 companies presenting on Investors Day where investors can meet, and it's free for investors to attend. Closer to home in Belgium, we host the annual Insight event, and next year it will take place January 6th at the Carter Hotel. We'll bring together 4 company CEOs, a leading investor, and a sell-side moderator to discuss the year ahead in an interactive setting. So that gives you a sense of who we are and how we operate. Let's now take a look at listed real estate universe itself. Listed real estate represents around 3 trillion of market capitalization globally. North America, Asia Pacific, and Europe dominate. Sorry, next slide, please, Alina. Where emerging markets are becoming more meaningful. That split between REIT and non-REIT structures reflects local regulations, and new REIT regimes are being developed by a public affairs team, some close to completion, where EPRA is actively engaged with policymakers. To capture the investable part of this universe, we look at the FTSE EPRA Nareit Index series. So at the end of Q2, it included 479 constituents with a free float market cap of 1.6 trillion euros. This leaves around 1.4 trillion of listed real estate assets outside the index. So it's not irrelevant, but not meeting the ground rules needed for investability. Those rules requiring EBITDA thresholds, liquidity, and English language reporting are what makes the index a trusted benchmark for the world's largest investors. And because this series is customizable, investors can adapt to fit with their strategies. So with that perspective on global and investable universe, let's now take a look at the market context and outlook. Next slide, please. Thank you. So I want to do this across three key layers. So the economy, property markets, and listed real estate. On the economy, Germany's fiscal stimulus is giving some support to growth, though it adds to the financing costs. In the US, tariffs is creating uncertainty and volatility weighing on global growth. Inflation is broadly at target, but risks remain. And both the ECB and the Bank of England have cut rates, though further moves are likely on hold. On the property side, fundamentals remain steady, so leasing and investments at the prime end are pretty strong. Rental growth has been positive for 10 straight quarters, and capital values in Europe rose 0.4% in Q1, the third consecutive gain. But tariffs and elevated bond yields continue to act as headwinds, limiting transactions and weighing on relative attractiveness. For the listed real estate specifically, Q2 results showed resilience. So more than 90% of the companies reported outstanding, positive, or neutral results, with low vacancies and steady rental growth. Valuations were mostly stable or slightly higher. Loan-to-value ratios remain under control. And while debt costs have risen, hedging has kept the increase somewhat manageable. Importantly, companies have raised 18.1 billion year to date, and many are planning expansion in 2025. Now, it's true that listed real estate has shown some more volatility and sharper drawdowns than global equities in recent cycles. But what stands out is the ability to absorb these shocks. Whether during the global financial crisis, the Eurozone crisis, or the pandemic, and continue raising capital. That resilience underpins confidence in the sector. So overall, we see solid operations, cautious investors, and a sector that is positioning itself for recovery. So the big question is how the market actually reacted since the new tariffs came into place. Let's take a look. Next slide, please. Looking at performance since the so-called Liberation Day, European listed real estate has been one of the strongest performers. By the end of Q2, the sector had returned nearly 11%, second only to travel and leisure, and well ahead of most other equity sectors at the European equity benchmark. Of course, this was the end of Q2, so the performance may have shifted somewhat since then. Initially, listed real estate was caught up in the general sell-off with equities when tariffs were announced, even though the companies themselves were not actually directly affected. That volatility was driven more by concerns over growth, inflation, and business sentiment. So the key reasons why the relative outperformance we see two. One is that tariffs hit other sectors directly, such as automotives, basic resources, and healthcare, and the capital rotation. There's clearly a shift of money moving away from the US into Europe, which has supported European listed real estate. At the same time, the bigger picture still remains rather complex. So feedback from investors when we speak to them still suggests that UK is facing a tougher period due to the interest rates, and it is difficult to see a broad global recovery without the US. So these processes do take a little bit of time. So while listed real estate has clearly been a relative winner in the immediate aftermath of the tariffs, the investor sentiment overall still remains rather cautious, particularly with challenges in the UK and uncertainty in the US. That's the short-term view. To get a clearer sense of what this could mean for the sector going forward, it's worth stepping back and looking at how listed real estate has performed historically through different cycles. Next slide, please, Aliano. So this chart looks at how European equity sectors have performed in the year following ECB cuts. In light blue, you see the performance 1 year after the first cut in a cycle, while the darker blue bars show the performance 1 year after the last cut. What you can see is that most sectors do benefit, but listed real estate has consistently been one of the top performers, averaging around 12% after the first cut and 11% after the last cut. So to put this in context, the broader equity benchmark sits closer to around 5 or 6%. So listed real estate has historically delivered almost double the market average in these periods. Now, we don't know yet whether the most ECB move was the last cut in the cycle, but some economists think we may already be at the near or at the end. Year to date, listed real estate is closer to around 8%, which fits with the pattern we've seen in past cycles. So now let's move to look at valuations and forward returns, which gives us another indication of what might lie ahead. Next slide, please, Aliano. Thank you. So this slide shows the relationship between discount to NAVs and the subsequent performance of European listed real estate. The dark blue line is the premium to discount to NAV, and the light blue line is a 3-year forward total return. The right axis is inverted, so you can see them moving in the same direction. And the relationship is relatively clear. So when discounts are deep, forward returns have been strong. At the end of Q2, the sector traded at around 24% discount. Historically, at similar levels, the market delivered around 11.5% 1 year later, 8.5% 3 years later, and 11% 5 years later. So that implies potential returns could be around 15 to 20% over the next 3 years if the pattern does hold. And we've seen this before. So after the global financial crisis and the Eurozone crisis, steep discounts were followed by recoveries. And the data suggests we may be at a similar position today with valuations still low, but history pointing to a likely pickup. Now let's look at research evidence to show how listed real estate impacts portfolios. But before that, let's look at how investors apply it in practice. So among the 25, thank you, Aliano, among the 25 largest European institutional investors, more than half, about 56%, allocate to listed real estate alongside their private holdings. And if we look globally, the figure rises to about 68% of the 25 largest investors worldwide. So these are pension funds, sovereign wealth funds. In other words, these are some of the most sophisticated asset owners. So listed real estate is not just niche or kind of an afterthought. It's already a standard part of the toolkit for many of the world's largest investors. And the reason is clear. So research consistently shows us that adding listed real estate improves diversification and strengthens the risk-adjusted returns. So let's look at that in more detail with the next slide, please, Aliano. So this study from Oxford Economics looks specifically at the effect of combining listed and direct real estate. So on the left side, you can see the sharp ratios by sector. And in almost every case, combining listed and direct, shown in yellow, delivers higher risk-adjusted returns than direct only, in blue. So there is one exception in retail, where the benefits are smaller, but this is most likely due to a lot of restructuring that took place in the listed real estate space. On the right side, you see the diversification effect. So direct portfolios are often much more concentrated, particularly in office. Added listed broadens the opportunity set. So healthcare, self-storage, and other sectors that aren't always available privately. This analysis covers a 14-year sample from 2010 to December 23, and the conclusion is consistent. A blended strategy of listed and direct real estate delivers stronger outcomes than relying on private alone. So the natural next step is to ask, how does this play out in practice? And for that, we can look at real-life performance data. So in September 2023, we commissioned CM Benchmarking. It's a leading provider of fund benchmarks. Some of you may be aware of it, to analyze how listed real estate has performed within institutional portfolios over the long term. Next slide, please, Alia. So just a little bit about CM. So they have over 30 years of data, and it covers more than 1,100 institutional investors across 20 countries and covers 14 trillion euros of assets. So the methodology is quite rigorous. So they have formulas that let them delag and rebase returns. So listed and private can be compared on a like-for-like basis. And looking at performance first in the Netherlands, so the Netherlands is Europe's largest pension market relative to its GDP. Listed real estate delivered long-term net annual returns of around 7.5%. Now this includes the GFC, the Eurozone crisis, and the pandemic. Importantly, those returns put listed real estate alongside private equity and listed equities with a lower cost and above direct real estate. And on the right, you can see in the US, the picture remains relatively similar. So this report also looked at correlations, which I don't really have time to go into detail here due to some constraints, but very briefly, I wanted to touch on this. In the Netherlands, the as reported correlation between listed and private is 0.27. But once it's been standardized, it rises to 0.86, showing the two are closely linked. And at the same time, listed has a low correlation with fixed income, making it a useful diversifier within pension funds. So to close this section, I want to highlight a real world example, Norges Bank Investment Manager, which is the largest asset owner globally. And they've spoken publicly through our platform about how to use listed real estate, not as a substitute, but as a way to gain diversification at scale and at pace. And it's a clear illustration how this research translates into practice. Next slide, please. So Norges Bank Investment Management, they manage around 1.35 trillion euros. Real estate is a meaningful part of this, and they manage 54 billion euros, and it's split roughly 50-50 between listed and unlisted. And their philosophy is quite simple. Real estate is real estate. So by running a combined strategy, they can treat listed and unlisted as one allocation. So this broadens their investable universe and helps with diversification. So let's take a look at an example. So in office, it's come down from 60% in 2019 to around 30% today, with listed giving them access to sectors they can't easily reach privately, like residential, healthcare, and self-storage. That long-term horizon means they can absorb the short-term volatility that comes with listed markets. And importantly, they also use listed as a learning tool, so a way to gain exposure to new emerging sectors before moving into that direction privately. So this is a very practical example of how one of the world's most sophisticated investors uses listed real estate and unlisted real estate together. So not as a substitute, but really as a complement to build a more diversified and resilient portfolio. So I hope this information has been helpful. And with that, I'll hand over the floor to Chris, who can take us a deeper look into portfolio construction. Thank you.
Hi, sorry. Thank you very much. I see we still have a couple of minutes left, so I will go a little bit faster. I also want to thank Eleanor for the help because she's pushing the button and go to the next slide. Thanks, Eleanor. So first of all, the portfolio construction philosophy, we all know that we have the equity bond split and we try to improve the return, the risk-adjusted return of our portfolio. This is the rationale behind. And if we now look to the latest ALM assumptions, because that's the basis we define our strategy, there we see there's an increased correlation with equities, what we have heard before, but there's still room and it still improves the return risk profile of your portfolio. So there's still a diversificator. Note, however, there's quite some sensitivity to the long-term interest rates volatility. We have seen that lately that due to the increase of the long-term yields, valuations of listed real estate were impacted. So this is still the case and can happen in future. But overall, in an ALM environment and setting your strategy, despite the increased correlation, we see still that the listed real estate part, adding a listed real estate in your portfolio can increase your return risk objective. So if you go to the next slide right now, so this is something if it goes to the next slide. Yes. Why do we see so, and this is maybe also more in a Belgian context, why do we see that clients are considering listed real estate versus direct real estate? Why are they choosing that? There are quite some good reasons to do so. The first thing is if you want to invest in real estate and you go to the direct route, it takes a little bit more time. It's more time consuming. So if you want to have a quick access, listed real estate can be a good alternative. The second thing, and that's something we see quite often in a Belgian context, pension funds are on average quite small, so they don't have a lot of governance. So, and if you're believing that real estate is a valuable asset class, what it is, then with listed real estate, you can access that much more easily with less governance. And that's also important in a Belgian context. The third thing, and that's maybe we haven't tackled that during the seminar here, is liquidity. Because listed real estate is liquid, you can sell and buy it at very short notice. While if you're invested in unlisted real estate, it takes a lot of time to enter, but also to exit the thing. So the liquidity is also an advantage for listed real estate. It also has appropriate diversification that has been discussed by the two speakers before in detail. It can add diversification to your unlisted real estate portfolio, but also in equity bond split, it can add a lot of diversification. And it can also, what can be interesting, you have a certain unlisted part in your portfolio, and with adding a listed real estate, you can play on different themes and add value there. And the last one is also costs. In an unlisted real estate portfolio, the costs are normally a bit higher, and with listed real estate, you can access that interesting asset class faster at a cheaper price. So if you go now to the next slide, taking into account the timing, you still have 2 minutes left. What do we see then in a global, in a European context versus a global context? We still see that, and that's especially maybe in the German market, that some still prefer direct investment over listed investment, although there are some very good reasons why you should also include listed real estate in your portfolio. The second thing is, and most of the direct real estate investments are on an European basis, and therefore it's sometimes interesting if you go with your listed part, maybe also add a global approach, because that will increase your diversification. If you now look, well, on average, but what is the value of an average? We see that in average, in our European portfolios is around 20% of real assets, not of total assets, but of real assets. That's a very important difference, is in listed real estate. So this is the other parts are 30-40 direct real estate that you have infrastructure and all the different other real asset class. If you go to the Belgian market, and that's maybe important there we go more often, especially for the smaller funds, but also the bigger funds, due to the governance, time, the liquidity, it's quite often an issue there. Then it goes, they see that it's quite often they go more to the listed real estate than to the unlisted real estate. But, and that is something I see quite often in practice, the products that are available for listed real estate are quite different. So the selection of these and the way you construct your portfolio has an important impact on the outcome and the return and risk characteristics of your portfolio. It's really the selection of such a product is very important, and it's not that the asset class looks interesting, also the way you implement it and the product you select for that is very important, and a pension fund should really look at that, because the return difference between products but also the risk characteristics are quite important. So if you now go to the last slide, I'll go a little bit fast, apologies for that. Quite often they say listed or global real estate listed is not very good. There is some disadvantages. This is indeed true, and here we are just showing figures for the US, is that indeed the correlation has increased significantly with equities, but this is especially on the short term. As pension funds are long-term investors, because we are not short-term investors, we are long-term investors, you see, although the correlation on the short term has increased, on the long term over a period of 5 years, there you see that the correlation of listed real estate is much closer to direct real estate than versus equity. So you need to be patient. I think if you invest in these asset class, it gives a little bit more correlation, listed real estate versus unlisted, but on the long run, and as pension funds are long-term investors, it's still an interesting asset class, and it can be good to consider listed real estate as a diversificator in your portfolio constructions. Thank you. So now I will hand over the word, I'm 2 minutes over time, to Marc, who will have the Q&A and can put some questions and
Thank you, Chris, and also Serkan and Thomas for your interesting contributions. I don't think we have any questions in the chat. We did have
one, Marc. There was one question in the chat.
Yes, but I don't see it anymore. But if I remember correctly, it concerned tariffs and recent evolutions within the US, and whether that had any impact on the composition of the listed real estate funds. I think that Thomas and Serkan already mentioned that, but maybe Thomas, you could elaborate just a bit.
Yeah, sure. I wrote a written response.
Okay.
But I can also sort of verbally contribute. I mean, our experience has been that clients with global real estate exposure have seen their managers see forward-looking return opportunities in Europe and Asia increase, and so have therefore shifted their exposure to some of those opportunities to the detriment of US exposure. But it's true that the US market continues to be a significant proportion of the global universe, right? So global allocations will continue to have large exposures to the US. But we also haven't had clients seeking to materially change their global real estate securities exposure as a result of any views on the US specifically. Nor have we had prospective clients to listed real estate query the size of US exposure. But certainly there has been an increase in opportunity in Europe and Asia as a result of some of these global dynamics.
Okay, thank you, Thomas. Given the time, I propose that we end here. So just to close, I think maybe that listed real estate maybe is not the silver bullet, but certainly an asset class that deserves serious consideration, combining stability, diversification, inflation protection, while also presenting risks that require prudent management. I hope that today's discussion will have given you some insight and practical guidance needed to evaluate whether listed real estate could play a role in your portfolios. Of course, should you have any questions, please don't hesitate to reach out. We're more than happy to answer any questions also via email, of course. And in closing, I would like to thank the speakers, Thomas, Serkan, and Chris, and of course, Alianor for the organization of this event. Thank you for your participation. I hope it was helpful, hope it was insightful, and I wish you all the best and very pleasant afternoon. Goodbye, and see you again soon, I hope.